Welcome to the Rockstar Investing Podcast, where we look at what separates average traders from those who are absolutely crushing it. If you're ready to be an investing superstar, keep listening. If you want to get there faster, visit www.passiveincometrading.com. And now, your host, the Rockstar Investor, Nick Roberts.
What's up, everybody? Hope you're having a good day, good evening, wherever it may be for you. Now, in this episode, the idea is this. You know that show Mythbusters, where they take a common belief and they test to see if it's real or not? Well, we're going to do that for this episode. And so this is going to be the Rockstar Investing Mythbusters edition. Okay, so here's the thing. With investing, a big problem out there today is the fact that there's a lot of information saying things that may or may not necessarily be helpful. So for example, in the food industry, if you recall, they used to say that fat is the enemy, sugar is fine, okay? Sugar is fine, right? And everyone believed that to be true. And of course, what do we hear as a commonly accepted fact today is that all sugar is bad for you. Now, whether or not you're a fan of sugar, regardless, you have to admit that for years it was commonly known, and I'm using that in quotation marks, that sugar was okay for you. And now experts are saying, well, no, it's not really. You should probably avoid having a ton of sugar. And so what I want to do for this episode is simply find similar sayings and similar known facts, to use quotation marks again, but in the investing and trading world. Because you see, the thing is that most of us have heard those common sayings such as do well in school, get good grades, go to a good college, get a great job, save money and invest for the long term. And perhaps at one point that advice was really good, but lately it's been failing a lot of people. So now we're seeing job satisfaction has dropped to all-time record lows. We're seeing more and more interest in people needing to find a way out of the rat race than ever before. So what do we do? Well, we've got to debunk the myths about investing that are keeping people from winning the game of money or just keeping people out of the game entirely. We can't dig ourselves out of a problem by using the same thinking we were using when we got into trouble in the first place. So the key is learn the new rules of money and learn them from the people that are winning the game. Okay, so what's the first myth? Well, not surprisingly, many people are taught this one, and this one is the best way to invest is to buy and hold for the long term. You see, along with the friendly advice that is the old go to school, get good grades, get a good job, and save for retirement, you'll sometimes hear the addition that goes with it, and that is, and invest in a diversified portfolio of stocks, bonds, and mutual funds. Now, while this may have worked in the industrial age, this is actually terrible advice for today's modern world. See, no longer can companies be relied upon to take care of their retired workforce, and of course the government is running out of money for Social Security at a rate that is faster now than ever in history. And so the new advice floating around there now seems to be something along the lines of, you can't beat the market, just invest in the S&P for the long term. And to those that don't know any better, this can often seem like good advice. So for example, if you looked at a chart of the S&P index, which is a tradable security made up of America's top 500 companies, you'd have, of course, discovered that over a long enough timeline, there are indeed periods where the price rises gradually. And in hindsight, it's plain to see that certain trends were going to continue upward. But once you introduce human emotion at the time of such upward trends, a whole different picture starts to emerge. See, nobody knows when each bull market is going to start running out of steam. Investors can panic and make poor decisions. A lot of people usually enter markets too late because they experience FOMO, aka fear of missing out, and ultimately fear and greed kick people's ass to the point of stupidity, and many of the gains made by the average investor are completely wiped out during the first sign of a market correction. So the takeaway of this is that you can't leave your finances up to chance. You've got to find a way to take matters into your own hands, and you've got to learn how to trade without emotion, which is of course easier said than done, but it is one of the things that we have to focus on as traders and investors so that we're seeing both sides of the fence and aren't blinded when markets start swinging upwards or downward really quickly. Okay, now building off that, we've got myth number 2, and that is that investing is hard. You should let the professionals handle it because they know what they're doing. Now, the problem with this common saying is that more often than not, these said professionals usually turn out to be one mutual fund or another that promise you steady or even lavish returns if only you'll trust them with your retirement savings. But the unfortunate truth behind mutual funds is they aren't exactly accountable for any losses in your account, even though they're the ones managing your money. And ultimately, these losses are yours and yours alone. Now, while a mutual fund will happily take a percentage of any capital gain they generate for you, they don't share in any of the losses. Furthermore, when they do lose money, it's often quite a fair chunk of your total account's value. See, mutual funds aren't required to be risk averse. In fact, they're not even allowed to trade certain derivatives that help lower your account's risk. And because they make a commission on the profits they generate for your account, most mutual funds will hold larger positions with your money just so that their share of the profits, if they even occur, are higher. And this is why so many retirement accounts get wiped out when a market crashes, ultimately leaving their owners with next to nothing. Now, on top of all this, a mutual fund will usually charge you fees on top of fees, which is in truth how they actually make most of their money. And so again, ultimately, it needs to be you that takes control of your finances. Because while a very small percentage of mutual funds do actually make small positive returns for several years in a row, nobody is going to be more concerned or more focused on building your portfolio than you are. Okay, next big myth out there. This one's for all the gamblers out there, okay? Now, this myth is this one. You have to bet big in order to win big. Not true. Let me explain why. Okay, so in Vegas, if you were to visit the roulette wheel, you'd notice that in order to win big, you have to bet large amounts against a probability that is not quite within the realms of probable favor. But most people know the saying, the house always wins, right? I mean, statistically, every dollar you spend at the casino is meant to give you around 90 cents back. And that's what's called the casino's edge. In fact, a casino will happily spend time, resources, free drinks, and advertising dollars just to have you sitting in that seat because they know their chances of taking your money are so darn high. Now, here's the thing. The casinos also have limits on the amount you're allowed to gamble on with any one bet. So this is because they also know that it takes time for the odds to turn out in their favor. So, for instance, when you flip a coin, the result could be heads or tails with a 50-50 chance it lands on either one. If you flip the coin, say, only 4 times though, you might find that it's not always going to be a perfect 50-50 split when you look at the results. And that's because it takes larger numbers of data to see how the probability works out more accurately. So if you flip that coin 1,000 times, you'd see a much more reliable packet of data, and you'll notice that you'll be much closer to a 50-50 split on those results. Now, applied to something like the stock market, the same thing applies. One thing I teach my students at Rockstar Wealth Academy is to always look at how the law of probability of a particular trading strategy applies to what you're doing. And once you find a high probability trading strategy, it's then wise to trade it in smaller amounts, but in larger numbers over time. By the way, if you want to see one of these strategies in action and create some passive income from the stock market, there's some free video training over at passiveincometrading.com. Head on over and check it out. And if you like what you see at the end of the free stuff, come join us, become one of our esteemed members. If not, that's cool too. Just keep listening to the free stuff. No dramas. Hope you like it. Alrighty. Now, before we go ahead and wrap up the episode here, there's one last myth we have to bust, and it's this one. Market crashes are bad. Yes, I said it. Market crashes being a bad thing is a myth. Here's why. See, when the markets crash, one of the biggest exchanges of wealth begins to occur, and it's how the rich get richer while the poor and middle class get deeper and deeper into financial trouble. Now, this is because when signs of a crash or a recession start to appear, and as the power of human emotion takes over, greed quickly turns into fear and people start selling like crazy. And of course, this often leads to a downward spiral until the market finally hits rock bottom. However, during this crash, what you're not seeing are the huge amounts of money being made on the way down. You see, the world's best investors profit from a crash by either shorting positions or buying a type of option called a put option, which are options that allow you to sell stocks at predetermined prices, so they go up in value very rapidly during a market crash. But even those who don't know about these strategies often miss out on what is one of the best trading opportunities that exists when the market hits rock bottom. Because here's the thing. Don't you think it's kind of funny that when Black Friday hits and buyers are literally trampling over each other to get the best deals, people seem to grasp the idea of a good sale. Yet when Wall Street goes on sale, there's no one to be seen. And even if you have no idea how to short a stock or buy yourself a put option, you can at least see that a market crash can be a helpful thing for you, the investor, if you can summon the will and the wisdom necessary to pull the trigger at the right time. Again, it all comes down to keeping your emotions at arm's length when it comes to investing, because as we all know, emotions can blind us and keep us from seeing the bigger opportunity. Alrighty. Hope this has been helpful, folks. Remember, if you like this kind of stuff and you want to dive in a bit deeper, head on over to www.therockstarinvestor.com. Grab yourself a copy of my book if you haven't already. Either way, hope to see you again soon. Happy trading, everybody.